All right. Good morning, everybody. It is October 19th, 2023, 8:45 a.m. And we've got a lot to talk about. This is a very interesting market that we're heading into, especially today, for a lot of reasons. And there's a lot of stuff we have to discuss. Now, the reason for this, or the reasons for this, because Tesla and Netflix reported yesterday. Tesla crapped the bed. Netflix actually made its bed properly. So Netflix got rewarded. Tesla got disregarded. Both of those companies, very big companies in the overall stock market, part of a lot of ETFs. So it's going to have an impact on what we're seeing today. On top of that, so you got Tesla and Netflix. Then you got companies that reported today, and some of those results just weren't amazing. Truist reported. We'll talk about them. Truist results actually were pretty good given some of their reports, and not phenomenal, but in this macro environment, definitely not bad. You've got American Airlines that posted a third quarter loss and trimmed their entire 2023 profit forecast. That wasn't that good. And you had some other companies report that were just like kind of slashing guidance, things of that nature. And it's starting to come up as like a weak Q3 start to earnings versus a super strong start to earnings. Now, maybe because it's not the tech sector and the tech sector is going to be a lot stronger, but that's some of the pain we're seeing right now. And then on top of that, you've got this glooming 10-year at 4.934%. Just hovering over everything that's going on right now, and it's casting doubts on if the equity markets have a chance to be able to rise. So we've got a lot to talk about and a lot to get into. Obviously, those earnings yesterday, they're going to have an impact on the market, and this 10-year is going to have a massive impact on the market as well. So let's get into all of that stuff. Peter, Joseph, Kevin, Mr. Seymour Duck, Broccoli Bob, Raul, Miami Ren, Vincent, Imnop, SJ Garcia, Ty Gordon, Daphne, Sean Trades, what's up, Sean? Lenny, Tony, Jude Jr., James, JH, Amit, Tesla, creator 13% in a week. Yeah, that one, that's tough. We're going to be talking about that. Andy, I love Palantir. Well, good morning to you too, Andy. Andy H. Oh, we got another Andy. Andy with an I and Andy with an H. I love it. Gabar, Kimberly, Kane, Victor. Thank you all for being here. Drew, good morning to you as well. Kimberly, good morning. All right. So, let's get into it. I think let's start off with the 10-year. That's kind of the biggest issue I'm seeing in the morning. So let's discuss that. Felicia, thank you for being here. Saskia Rose, Christian, Mr. Russo. Here you go, folks. This is our beautiful 10-year in the United States of America. You know the interesting thing about the 10-year? When I was 10 years old, I actually enjoyed life. Okay. I went out. I didn't have any issues. I had no responsibilities. I got to eat ice cream whenever I wanted. Got to watch as much Nickelodeon. With the 10-year, when I was 10 years old, almost 16 years ago from October 27th, when I'll be 26, I had a blast. Life was fine. The year was 2007. We were basically about to go into the biggest recession we've seen since the Great Depression. And when I was 10 years old, I didn't even care about it. I was just going to school, doing my thing. Now, when I think of the 10-year, the level of trauma that I'm basically interacting with every single morning, given my prior experience with the concept of being 10 years old, is just asinine. Okay, 4.932%, inching towards 5%. It's just not good for us to be at this level on the 10-year because equities are not going to be able to give the return that we want them to give if the 10-year is at this level. And that's what we're seeing with this 10-year at 4.932. We got Michael who says the 10-year is going to crash soon. And then obviously we got other people saying that the 10-year is going to continue to go higher. And no one really knows, no matter how much we think we know. What controls moves the 10-year treasury yield? Basically, if people keep selling it off, the yield will go higher. And as of now, people are selling it off. Therefore, the yield is getting higher to become more attractive in order to get people to buy. Remember, you're buying U.S. debt when you're buying the 10-year. And if people are selling our debt, then that means that they will continue to raise the yield. And eventually that will lead liquidity out of the stock market into the 10-year. So, it's not necessarily the best. Yes, the higher 10-year just does uninvert the yield curve, but that does mean that obviously that looming little recession is going to happen soon, and if that does happen, well, maybe that. See, here's the thing about the recession. We've been talking about it. Maybe it does happen, and it's like, it happens, and it was whatever, kind of like a 2022 type of, 2-quarter GDP recession, all right, whatever. Or it happens, and it happens, like it really happens, and equities take a while to recover from that. Remember, if we do get a recession, maybe that's what breaks the economy, and then the Fed finally lowers rates, and that's also going to be really good. But if they don't lower those rates anytime soon, then that's going to be tough. Bro, we already had a recession in 2022. Garcia says, yeah, we did. Seems like that one didn't count. Seems like we need another one to really count. And remember, we did have, I think, from Q2 to Q3, 2 consecutive quarters of negative GDP growth. So we had the recession, and now JP Morgan's GDP growth for Q3 is like 3.45 or closer to 4.3%. But as of today, it doesn't matter. Like in Monday, Tuesday, the markets were going great. S&P 500 was inching close to 440. You had all the big banks saying that, there's going to be a great sort of 2024 run. And then in a matter of literal days, you can have a 10-year to go from 4.9. It's like something traumatic happens when you're 10 years old and you have to turn 20 in a matter of days, where you have to become an adult. That's basically what happened in a couple of days. We all became adults because the 10-year went to 4.9. So right now, S&P 500 at 430.76. American actually up a little bit, 2.8%. United is up a little bit after recovering from a 9% decline, and Delta is up a little bit. So we'll see how the market recovers to it. Palantir is at 1734. Again, that 10-year might be normalizing at that 4.9 level. I don't think that's the case. I think 4.4, 4.5 is where it normalizes, and the market's okay to buy equities with the 10-year that's that high. But at 4.9 today, we either go to 5 or we stay sideways or we come down. But one of those things is going to happen, and seems like inching higher every day. It is possible for it to keep going. MGR, hello. Thank you for being here. Matt, the auto market makes me scared about the economy. Lots of defaults on car loans. Yeah, that's another thing. We were talking about it yesterday on Finance Junkies, but who's going to pay an 8% mortgage, right? Mortgages hit 8% yesterday officially. Who's going to pay that? And just like auto cars, like who's going to be able to pay these ridiculous car loans that they have, much less buy a new car, which means you would imagine these prices have to come down because the lack of demand just is not there. The demand to be able to buy a house can't be there. The demand to buy a, $800 car payment on a house just can't be there. And if it can't be there, then eventually we have to see that come down. The question becomes, at what cost does it come down? The bull case for this coming down is that inflation's coming down, which means Fed will cut rates, right? So all the bull cases for the economy is too expensive right now. Any types of credit events means that rates will be cut, which means equities go up if rates get cut. The question becomes, what's the timeline on all of that happening? Because that timeline will determine a lot. Okay, let's talk about Truist real quick. Obviously, this is a company you guys know I have a big position in. I'm a fan. I actually woke up and I got the notification that their earnings call was starting. And so I started listening to some of their earnings call. The results actually were not too bad. So Truist right now in the pre-market, the reason it's up 28.93, I don't think it'll be up for the rest of the day because that 10-year, again, not going to let, I think, a lot of companies run today. It did get to like 29.30 at one point in the pre-markets, but these were the results. It really wasn't that bad, quite frankly. Revenue is down 2.6% year over year. That's not that, we knew revenue would be down, but we beat by 20 million. Q3 non-GAAP EPS of 84 cents beats by 1 cent. So, I mean, we beat by a cent. A lot of people thought EPS would suffer, but we did beat by a cent. And net interest income declined 1.6% from the prior quarter compared with a 6.1% decline from last year at this time, which makes sense, obviously, because of interest rates becoming higher. Non-interest income was down 8.1% due to seasonally lower insurance income and an $87 million reduction in deposit service charge fees due to client refund accruals. The biggest thing, and I'm going to try to go to their website as well, pull up their deck. The biggest thing around Truist is they said, we're cutting $300 million of costs by the end of the year. Deposits are not necessarily being hurt. And then on top of that, they mentioned that they are normalizing a lot of the issues in order to deal with a rising interest rate environment. And they're normalizing them in a pretty unique way. So here it is. So expenses well controlled. The $750 million cost saves program underway. They said they had solid third quarter results. Increased their CET1 ratios 29 basis points, which is probably because of the sale of their insurance business, which is very good. That means they don't have to sell any of their loans that are underwater, that eventually will not be underwater when the interest rates come down. So that's very good for them. Maintain stable asset quality metrics with NPLs flat and ALL higher, and key actions taken to our organizational alignment and simplification efforts. This is referring to the merger between SunTrust and BBT. So $1.1 billion of net income. All right, not horrible. Total revenues down 4.1% in this macro environment, not horrible as either. Net interest income declined $58 million or 1.6% quarter over quarter with a $240 million sequential decline. So again, it was higher in 1Q, but that was before Silicon Valley Bank collapsed and all this stuff that ended up happening. And then on their loan sheet, average loan balances decreased to $8.3 billion or 2.5%. And they got rid of their $4.8 billion student loan portfolio, which is really what allowed them to be able to do it as well. I want to go to their deposits. Okay, so here are their deposits. So this is the big one. Last quarter, they had $276 billion of deposits that they had money that was being garnered off of, and then $124 billion in just money that's sitting on their sheets. This quarter, look at that. They increased deposits by $1 billion. They have $401 billion. $1.2 billion. Average deposits increased by $1.2 billion. So this is why I like Truist. For all the people saying it's a region, I actually researched some of this stuff. But if you guys go on Twitter, the amount of FUD, if you just type in Truist Bank, the amount of people that are saying this is the next bank to collapse, this is where the bank run's happening, it's just utter bullshit. And I would take it seriously if there's any level of sophistication to the claim, but there's no sophistication to the claim. And this matters whether or not you own the stock, because if this regional collapses, your stocks are not going to do well, because this is a super regional. This is the 7th largest bank in the United States of America. If that regional collapses, there's going to be a lot of companies, or there's going to be a lot of economic distress, and obviously a lot of companies that are going to be affected by that. They increase their deposits. And $1.2 billion is not a lot, but in a world in which JP Morgan and Goldman Sachs and all those guys are losing deposits, for Truist to actually increase their deposits, that's pretty nice to me. If you look at the book value of Truist, if you take their assets minus their liabilities and include the AOIC losses, the book value is $40 a share. Stock's at 28. It has an average price target by most analysts, if you just give it a healthy PE multiple, of about 57. So that's why Truist is so attractive. The question becomes, when will the Fed lower interest rates to be able to get that stock to go up? But in terms of the fundamentals of the business being protected, and I'll go deeper into it later as I go through the earnings, everything I'm seeing is fine. And it doesn't look like it's necessarily in a tough position at all. So for those that own Truist, I think we will be okay. And we shouldn't have to worry too much about what's going on with the company, at least for now. Obviously, if the Fed continues to raise rates, then all the banks are screwed. But I don't think the Fed is raising rates again. If they do, then yeah, we're going to have some problems. All right, so that's Truist. Let's talk about Tesla. Obviously, that was a big one. There was a lot of discussion on how Elon was conducting himself on the phone call yesterday and how he kind of thought about it. He really just sounded depressed, didn't sound that happy about it. So let's get an update from Gene Munster. He has a very significant position in the stock. The price of Tesla real quick before we get into it. Tesla My Esla is... Oh, wow. It's down another 6.1% in the pre-market. Wow. It's down to 227. So it was down 5% yesterday. It's down 11%. That's down almost $30. No more than that. Yeah, a little bit close to $26-30. Yeah, okay. So Tesla's going to maybe have an ugly day or maybe gets eaten up. Let's see. Let's get a little update on Tesla, then we'll talk more about it.
This morning, after the EV maker missed on both revenue and earnings for the first time since 2019, the stock was flat following the release, but took a turn lower during the earnings call when CEO Elon Musk struck a pessimistic tone, saying he's moving through the current environment with a degree of caution. Joining us now with more, Gene Munster, Deepwater Asset Management managing partner. Gene, good morning. I was just looking at the beginning of the third quarter. The estimate for the third quarter for Tesla was, I think, an 84 cents in earnings. The estimate got whittled down to 73. It comes in at 66. A lot of focus on the automotive margins once you exclude those vehicle credits for zero emission vehicles. So where does that leave us here in terms of the earnings power, how much more they're going to have to deal with in terms of price cuts and margin pressure, and how does it feed into the whole story?
Well, margins are the critical point, Mike, and ultimately they need to improve those margins. Musk was clear, don't expect margins to move higher over the next year as they start to ramp Cybertruck. And so this is really the battleground. This is the center vortex of the whole Tesla story. It's about margins. Margins go up, that means that this is a tech company. Margins go down, it's a typical car company. And so that's why there's so much weight on that all important automotive gross margin X credits. Now, just frame in one other detail there. It was 16.3% in the September quarter. It was 29% a year and a half ago. These margins are now approaching traditional automakers. Now, granted, traditional automakers lose a ton of money when it comes to their electric initiatives, but they are approaching those lower margins. And so, Mike, what does this mean? It means patience is a virtue. Elon talked about this being a challenging period. He used that phrase twice in his prepared remarks. He did not talk about challenges in the June quarter. And what essentially the setup here is that investors who believe that this is a tech company, I'm one of those, have to wait an extra year plus before we start to see some of those margins improve. There was another layer of disappointment on the call too, is Tesla has been steadfast with this 50% compound growth expectation. And Elon started to back off with some of that language, saying that it's just impossible to continue to grow at those rates. And so when we think about Tesla and the story for the next 5 to 10 years, that 20 million vehicle number in 2030 just got a lot harder after his commentary last night. And so,
all right, let's talk about Tesla. First of all, put in the chat what you guys thought about their earnings yesterday. I'm curious for what you guys have to say. I know a lot of you own this stock. And can someone explain to me also why he didn't like his CFO? I didn't get to hear the specific moments, but apparently a lot of people were saying that he was speaking over his CFO. I think this is like the interim CFO or something. The old CFO, Zach, right? He left a couple of weeks ago or months ago. And so Elon was a little bit, kind of on edge. What Gene is saying here is that this was the first quarter where they just didn't do as well of a job as they've done since 2019, because obviously they missed on EPS and revenue. And I do want to say, look, missing on EPS and revenue, those are just silly numbers that the street cares about from a quarter to quarter basis. They're not like the objective numbers that define the trajectory of a company and the existential nature of if a company is going to survive. Now, if there's a trend of EPS and revenue declining, then that's obviously not good. But one quarter in 5 years since 2019 of EPS and revenue being down, that's okay. The problem is the timing of it is a little weird, right? Because we're seeing a lot of uncertainty in the macro environment. And as a result of that, if the numbers are bad, could that be a trend going forward? What I took away from the call is this was one of the first calls where Elon actually sounded like he was actually concerned about the macro environment. He was worried more than normal about what the Fed was doing and how interest rates were ultimately going to affect the broader economy. We've got Gary Black, a big institutional Wall Street investor, tweeting this morning about his thoughts on Tesla. He says, Elon is overpaying overplaying the macro card. Do the math. Payments on a Tesla Model Y at a $50,000 price today are far lower with a 7.5% average interest rate on a 5-year car loan than they were a year ago with a Model Y at a $65,000 price, assuming a 10% down payment. Monthly payment today, $902. Monthly payment a year ago, $1,108. So the reason Gary's posting this is because he's basically saying, look, a year ago, the monthly payment for a Tesla was $1,100. Now it's $902. So Elon can't blame the macro. I personally think this is ridiculous because a year ago, we did not have interest rates as high as we did. And a year ago, the consumer was in a far better position than they are right now. I don't think you could argue that a year ago, the consumer was like worse than the consumer is now. I mean, we've had a lot of bad stuff happen in a year, even if the stock market has done well, right? I mean, 2 whole banks collapsed, for goodness sake. 3 banks, right? Credit Suisse, Silicon Valley, and First Republic, like the FTX, like, a lot of stuff happened since then. So Gary's trying to basically call Elon on his BS, quote unquote, around blaming the macro, because that's what Elon did for a lot of the call, and basically say it's not a big issue. He also says most people I spoke with tonight thought the Tesla earnings call was not good to terrible. Lots of excuses about macro. New CFO seemed unsure. No answer to question about auto gross margins bottomed. 25K car should be highest priority. Didn't address the question why not buy down loan rates to 2 to 3% rather than cut prices by 20% to address affordability. As one project manager said to me, with Zach gone, Elon seems surrounded by people who are afraid to disagree with him. Wow. That's a hell of a comment. That's Gary Quarterly back Black. The only reason I think it's important to take into account Gary's opinion is because he's on Wall Street and he speaks to these guys on Wall Street and he publicly tweets about it. So that's why I actually think it's interesting to hear him talk about it. Let's see what he has to say. Here's a minute of him talking last night about earnings.
2021. Now they're saying really promise we actually mean it this time, November of this year. So basically the end of next month. You're very bullish on the Cybertruck. Are you bullish on this date for the Cybertruck?
Yeah, it seems like the date that keeps moving. Look, Cybertruck is the biggest thing that's going to help Tesla
The date is November 30th, by the way.
Stock. It's one of the reasons we're in it. It'll produce a halo effect for the entire franchise. People will see it. It'll be like a rolling billboard. They'll go to the website, they'll find it, and maybe they buy a Model 3 or Model Y. I'm very optimistic about the Cybertruck. When you ask truck drivers in their 30s and 40s, it's something they love. And if you talk to a 60-year-old truck driver, pickup truck driver who drives a F-150, he may not be as excited. But I think you're going to see a halo effect to the entire franchise once it gets out there. November 30th, I hope it gets out there November 30th. As you said, we've been waiting for this for a few years, but it sounds like, and when you see T-shirts are going out to stores, there's Cybertrucks all over the country now. It feels like it'll happen at the end of November. So it's why we stay with the stock. And look, we don't like the fact that auto gross margins missed. We don't like that there was no indication that they bottomed. But when I look at the stock, it's 55 times next year's earnings. It's growing at 35 to 40% a year. I'm a growth manager. It's hard for me to find stocks with that level of PE versus growth. It's about 1.4 times.
The thing, and notice what Gary just said, right? He's a growth investor. It's hard for me to find other stocks that'll grow like that. And he's betting on Cybertruck for his growth. Notice he didn't mention FSD. He didn't mention the bot. He didn't mention robo-taxis. And that's kind of why I also think his perspective matters, because he's one of the more practical Tesla bulls, in my opinion, where he says, look, I'm looking at the numbers and I'm trying to make assumptions on the numbers based on the growth I'm getting from the numbers. I'm not looking towards FSD and all this stuff in the future that's truly just not factored into the numbers yet. So this was the pure results. 3Q revenue, it was a miss. Adjusted EPS was a nasty miss. Free cash flow also, $848 million. They estimated $2.59 billion. That was a really big miss. And then gross margins, look, estimated 18% came in at 17.9. The street went crazy over that 0.1. That 0.1 does have impacts on Tesla's eventual profitability. But also what that means is that we may not have seen a bottom, a capitulation to those automotive gross margins, and they may be going lower, especially if Tesla continues to cut prices in the case of a massive recession or credit event, which in that case, Tesla stock is not going to be as cheap as it looks today. It's going to get much cheaper if that ends up happening. I mean, if we get a recession and the consumer can't afford to pay the prices they're paying right now, there's going to have to be price cuts, which means there's going to have to be margin cuts, which means Tesla stock will go down. It's just, there's nothing that could save this. Cybertruck's not saving that stock. And I think that's why he cares so much about this $25,000 car. Now, look, that was some of the bearish stuff on Tesla. The good stuff about it is that their volumes are incredible. And those volumes at the end of the day are the bull case for Tesla stock. We got TJ here, scooped up another 500 shares of Tesla for breakfast this morning. So TJ did indeed buy the dip. Pat P says not buying until 150. Slowing down the Mexico plant is a red flag to sell now and buy back at 100. Yeah, I mean, look, we will see what happens. The big thing, again, if you're a believer in the bull case of Tesla, your argument is volume, volume, volume. I read a tweet yesterday that YouTube itself is basically a loss leader for Google. I mean, if you do the math on YouTube, the cost that it takes to host all this video and to the bandwidth to actually remember, there's 500 hours of video uploaded a minute on YouTube. 99% of that is not monetized, right? YouTube doesn't make any money off that, but YouTube never charges people to upload videos. So if you do the math on it, YouTube is losing a couple $2 billion a year. But it gets people to come to Google, and then Google makes it up in other ways, right? So for Tesla, again, the cars aren't losing money, but you could argue that the cars don't really matter. It's just getting them out there into the world, because when they get there into the world, you've got this beautiful SaaS product that's going to monetize the crap out of it with FSD, and that's your bull case. The question becomes when that actually happens, and if that actually happens anytime soon. Curtis says, if it went back to 100, it would take years before it hit all-time high again. It's already been almost 2 years. I doubt we're going down past 200 again. I think it's very possible to go down 200. I mean, I think it could definitely hit the 180s. That's very likely. I'm not very likely. It is very possible. Now, does it go back to 100? I don't know. That one's a little hard to imagine it getting there. But it could definitely go lower for sure. TJ just shared a video of me, but let's actually, this is actually TJ, I'm gonna go to your channel right now. We're gonna watch this We're going to watch this video. So TJ has just started buying the dip on Tesla. This is what it looks like if you have money. You start buying these dips. While I'm pulling this up, again, you know, could it go below 200? Sure. Could it go back to 100? I think that's tough unless we have a massive recession and those prices have to cut even more and then the margins get cut. But in general, you don't care as a Tesla long-term shareholder, like Carlos was saying on Finance Junkies yesterday, if the stock goes down, because it's like you want to buy it, right? That's the point. Oh, TJ, I can't share this, bro. You have. Oh wait, no, I can mute it. I can mute it. Okay, because you have music on this. Okay, so here we go. Here's someone buying right in real time. For those that say people don't use Robinhood in a sophisticated way, here's someone with some money on Robinhood. This is what I will do for you guys live on the morning open in like 5 years. If I have some money, I'll be able to do this live for you guys. Right now, I have to buy like 10 shares for you guys live, but in the future, I'll do a lot more. There you go. 500 shares, 114 grand. He's not even putting a limit price. He's doing it straight at market price. TJ doesn't care. There you go. And it's on like an iPhone 8 or something. Boom. 228.28 a share, 500 shares. TJ, 119 grand. I want to be like TJ when I grow up one day. I just want to be like, bro, if I get rich one day and for the rest of my life, all I have to do is the market open and like I could just buy stocks like that. That would be so cool. That's the fun stuff we would do every day. He's using like an iPhone 5. That's the best, bro. For those that don't know TJ, I mean, like he's not the most technology literate. He'll admit it himself. So I remember the first time I was trying to get him set up on like StreamYard and stuff. He just wants the least barrier to entry, but he's got a lot of money and he knows how to allocate and he knows how to wheel. So as long as you give him a chance, he'll start spending. Man, I hope it goes lower. I'm watching and waiting. Yeah, let me know in the chat. I mean, are you actually, let's actually look at the stock right now. Do you want, I'll do a poll because I think that one deserves a poll. And then we'll transition from Tesla to another topic. We got 18 minutes until the market open. But Tesla right now, 227. Do you want Tesla lower or do you not want to see the pain? Let's see. Let's do a poll. Tesla lower. Yes, I'll buy the dip. No, don't do it. Okay. So yes, I'll buy the dip, or no, you don't want to see prices go lower because maybe you have a great average and you don't want to deal with those losses, or you don't want to deal with the emotions of having go back down to 170, 180, because that's also something. One thing that, you know, if Elon says people aren't buying, you know, or they're going to still stay to that 1.8 million deliveries, but if people in general don't feel like they can buy Teslas because of the interest rates, obviously EVs are much more expensive, you know, than some of the other cars, even though it's comparable now with the price cuts, then this guy's also going to suffer in their earnings. I mean, end phase, if people can't imagine interest rates coming down to finance a car, they're definitely not financing solar panels. So end phase's earnings, honestly, this stock's either going below 100 or back to, you know, some reasonable levels for it, because earnings are going to really determine a lot around what we see, or that guidance is going to determine around if we see end phase continuing to do well. Tesla now at 226. He did affirm, Elon said 1.8 million cars. He did say 1.8 million cars. So 1.8 million. Look, if they do that, they're going to have a record quarter. They're going to have, I think, 483 something thousand deliveries, something like that, this Q4. So Santa Claus better be getting people some Teslas for Christmas, because they're going to have to break some records to get to that number. But they reaffirmed it. That was, I think, another book. If they didn't reaffirm that 1.8 million, I think the stock would be even lower. So the fact that they did that is a good thing. Truist up 29.12 in the pre-markets. SoFi 780 in the pre-markets, down below $8 again. S&P 500 431. Palantir 1737 up 0.99% in the pre-market. Nvidia's at 429. ASML had a bad day yesterday, now back at 602, so it's kind of making up some of the losses it had yesterday. What else do we have here? Amazon is up a little bit. Google is up a little bit. PayPal is up a little bit today. Some of the stocks were recovering from yesterday, even Robinhood, because yesterday was a nasty dip for the entire market. Like, I looked at my portfolio in the morning. I was like, oh, I'm chill. Everything's okay. I looked at my portfolio at like 3 p.m. I was down $10,000. I was like, that's not cool. What that like we just recovered that from like 2 weeks ago. Now it's back. I was like, all right, I guess that's what we got to deal with. So yeah, that 10-year again really spiked things. For those that are just joining, I think the highlight of today, or the big story of the day, the 10-year is officially at 4.939%. that is going to make it very hard for equities to do well, even though we're seeing some recovery of equities because they got really oversold yesterday. At least that's what the charts are showing, given how all of them are green in the pre-market. But we will see in 15 minutes when the market opens how bad it ended up really getting. Practical Investing saying, I am not touching Tesla. Victor Hernandez was down 8,000. Tesla also increased their cash. They increased it by $3 billion. So they increased their cash on the balance sheet by $3 billion, which is really good, even though their free cash flow sucked. 1.8 million cars. There was a lot of bullish things to take away. I think the reason the market really didn't like it is because of it's just because of Elon's tone. I think Elon sounded like he was depressed, and that was a tough part. Okay, let's go to Netflix. Let's get an update on that. This was also big, and then we'll move on to some of the Fed chairs that are speaking later today, as you guys mentioned in the chat.
Earnings expectations as the streaming giant added nearly 9 million paid subscribers helped by its password sharing.
Let me just be the first to say I was wrong. The street expected 6 million paid subscribers. I did not expect 9 million. No way. I was wrong on that, but hats off to Netflix.
Sharing crackdown and cheaper ad-supported tier. The company is also flexing its pricing power, hiking fees on some plans as early as this week. Joining us now is Michael Nathanson, MoffettNathanson, founding partner and senior research analyst. Michael, I was just saying here on set during the break that there's 4 things that are important when you're the parent of a 20-year-old. When they come off your health insurance, when you stop paying their cell phone, when you stop paying their car insurance, and when you stop sharing your Netflix password with them. So what's going on here? Am I going to not be able to do this anymore?
Well, you're going to be able to do it. You have to pay more to do it, right? So what Netflix has done is they said there are 100 million homes around the world where people are sharing passwords. We've done research with PCH that says, to what your point is, Steve, the vast majority of sharing are parents and children. And at some point, your kids are going to be outside of the home. They're going to have to basically pay for their own their own password, or you will pay for it. So we're about halfway through that process right now. So we think there's another 2-3 quarters. And then a lot of that password sharing will either be paid for, or people will just not use Netflix at that point.
If I showed you the family text group that I have, half of the conversation is, what's the so-and-so password? That's all we ever talk about here. It'd be nice if they asked how I was doing once in a while, but they really just want the password. So were you saying we're halfway?
Okay, so Netflix again up 13% right now, $392. Remember, the stock was at $450 September 5th, went down to $305. Netflix right now, wow, $403 in the pre-market, up 16%. Netflix deserves it. Netflix absolutely deserves it. And the reason Netflix deserves it is because of the subscriber growth. Like, at the end of the day, if you're able to rack up those types of subscribers, 9 million subscribers is pretty insane. Now, granted, you could argue a lot of those subscribers are from different parts of the world, so the ARPU on them is not going to be that good. You got a lot of Appus in India that you're getting the ARPU off of, right? That are not paying that much money. That was a joke I used like 5 months ago. But so the ARPU maybe not be amazing, but the issue with using that as a bear case is that they still did 8.45 billion in revenue, 8.54. So it doesn't matter how they generated the revenue. It doesn't matter if they had 1 million people paying 2 cents a month and then 8 million people paying the rest. They got 8.5 billion in revenue. They met expectations, right? So the ARPU argument on Netflix that's more likely used against Spotify, that ends up missing their numbers but has a lot of MAUs, can't really make sense because they're hitting their numbers and they're profitable. This is one of the only streaming companies on planet Earth, not in the United States, on planet Earth, that shows a profit at the end of every quarter. And, HBO doesn't do that. Paramount definitely doesn't do that. Peacock, the most ridiculous name. What marketing person at NBC was like, let's call it Peacock? Let's do that. We have a lot of awesome shows like The Office. You have one of the most iconic shows of all time. It's streaming officially on Peacock. Who thought of like that streaming service was doomed as soon as that person got their job, as they had a marketing for Peacock. I mean, that's just ridiculous. So that happened. They're not profitable. And then none of these other guys, Fubo, Tubi, none of these other guys are profitable. So Netflix's real moat is that they're able to get subscribers. They're able to have enough content to compel subscribers, even though I don't particularly enjoy the content. And then on top of that, you have profitability, which is really important for a streaming company. Haley, what's up in the chat? Hey, Amit, is today the day you add Tesla? Honestly, guys, no. And I know it's going to upset a lot of you guys who look at the stock right now, but the stock theoretically to me could get lower if these automotive gross margins have not found a bottom. Now, on top of that, let me just preface this by saying I don't have cash. Okay. So like that's the first reason. So before you kill me, the first reason is the one you can't kill me for because I don't have the cash to buy. The second reason that I think is, more important right now is we just saw a nasty dip. I don't think you buy immediately on a nasty dip. I think you let the market bottom it out a little bit. So right now it's at 226. What if it goes to 230 and is there really a difference between 226 and 230? No. But you want to give it some time because if it could go to 220 from 226, right? It could go to the up or down side in terms of how we're seeing the stock action perform. I don't think you buy it immediately at the dip. I kind of think that's like a mistake. You wait till the dip kind of matures a little bit and then you decide to make a decision. Second of all, look, Elon wasn't that happy on the call. And if Elon's not that happy on the call, then I'm not feeling that excited to buy the stock. Automotive gross margins can be pushed down even more. It doesn't seem like interest rates are getting cut anytime soon, which here's a very logical reason for why the stock could go lower and why maybe 226 is not the best time to buy. If we don't lower interest rates until June of 2024 and people have a harder time buying the car, meaning the consumer is under pressure over the next 8 months, and Tesla needs to sell a car to make money, and Tesla does not have the $25,000 car in a really bad macro environment, then they're going to have to lower prices. They're going to have to lower automotive margins, which means they're going to have to lower revenues and profits, which means the street will tank the stock again. That is a very simple argument, and I hope that logically makes sense to everybody for why the stock could go lower. I think that's pretty simple. FSD, robo-taxis, Dojo, all of that stuff is a fantasy as of now because none of it's actually materializing. And so if it's not materializing, then it's not a way that you could factor into the stock. I've learned to not try and catch falling knives, cough, Palantir, cough. Yeah, also, I've had some experience with catching falling knives. So that's another reason why Tesla is a little bit tough to buy right now. But I think that's very logical, right? I imagine that's very logical. If we don't get any rate cuts soon, which is what Elon seemed upset about, then prices are going to have to come down, margins are going to have to come down, revenue and profits, EPS, all of that has to come down in order to get the volume needed to get people to buy the car, which for the bull case for FSD in the future is great. But for the short term, that's not great. The street doesn't give a shit about FSD. No matter how many times the Jonas Brother bands talk about Dojo and FSDs, no one really cares because it's not real. It's like Palantir talking about, oh, we're going to make so much money off AIP. It's like, well, the street doesn't think so. So until you show the revenue growth, that AIP is just a fantasy. And you can show me customer count. You can show me whatever you want. I want to see revenue. And until I get that, it's not happening. So I think the same with Tesla. Until they really show it, it's going to be hard for me to really be excited to buy the stock. And on top of that, I don't really have that much cash. So it's a little tough. Here's another perspective on this, kind of echoing what I'm saying. And again, we talked about the bull case on Tesla earnings, so it's not like we're being fully bearish here. But it wasn't the best quarter, and we got to give it some lip service. Here's the near term being quite challenging for Tesla from Wells Fargo.
Reported weaker than expected results in the third quarter. The EV maker had lower profit margins, but it is holding to the full year forecast and said that they expect to deliver 1.8 million vehicles for the year. That stock, though, down by about 7.2%. Joining us right now with more is Colin Langan. He is Wells Fargo's senior equity analyst, and thank you for coming in today.
Thanks for having me.
So we knew that the deliveries might be a little on the weak side, but I think it was probably the surprise of the profit margins and how Elon Musk himself described some of this. I think he said, in a difficult time, in a rough seas, even a big ship takes on some concerning issues, and you got to be careful about it. So we're not sinking, but it's a difficult time in the market. He acknowledged.
Yeah, I think that's fair. I would say, though, this does seem to be right now, at least Tesla specific. We've seen pricing hold up for other companies. And I think this is really just an impact of, cutting price to
try and win margin.
To win volume, actually. Yeah. And so I think that's the fundamental concern coming out of the quarter is you had not only a miss in the quarter, but, I think investors wanted to get a sense of two things. Where is demand going? And there was negative commentary on Cybertruck, negative commentary on the plant that's coming in Mexico that might actually get delayed a bit. That's the future volume growth drivers. And if those are getting delayed, we might have a demand gap. And then that means we're going to need more pricing to keep volume going, which means margins will continue to be under pressure. So I think from an investor standpoint, this is going to be not much positive coming out of the quarter.
Look, some long-term investors, if you talk to a Ron Barron or somebody, would say we're fine with cutting prices because this is a longer-term game. And if you look at companies like Amazon who didn't care about making profits at certain times, does Tesla have the same flexibility of a company like an Amazon, though? Do they have the same support or not?
Well, sure. Year to date, I mean, earnings estimates are down about 40% from the start of the year, and the stock's up 100%. So they definitely have some flexibility. I think the concern that I'd have is on that point is like the Mexico plant, right? That's the next volume driver, and that sounds like that could get delayed to some degree. That means if I'm a long-term investor, why am I delaying it? Like, why am I delaying it if interest rates is such a concern? That's actually going to be good for the lower, income customer.
Yeah, I think that the Mexico factory delay is something we didn't talk about too much. That is also something a little scary for some of these investors because, again, you got to crank up production if you want to. Remember, the Ultra Bulls are saying 20 million by 2030, and I've always been a little like, all right, how are you getting that number? Because you're barely doing 2 million right now, and you got almost 6 years left till 2030. Like the S curve of growth for those cars to be able to be produced, which is not an easy thing to do, and then delivered, and then actually have the demand for all of that, which I think the demand is there, but with interest rates, all that stuff, price cuts, it's you have to kind of manufacture that demand in certain economic environments. And interest rates don't look like they're coming down significantly until 2025, 2026. Like we are not from 2008 to 2020 anymore. We are living in a high interest rate environment. This is the world we live in. Even if it goes down 50 basis points, 25 basis points, even 100 basis points, it's still higher than it was for the past 12 years. That's a new world we live in. And that new world, in the words of Aldous Huxley, it's a brave new world. I might be saying his name wrong, but let me know if you guys read that book. It's a really good book. And in this brave new world, it's not as easy to access capital as it was back in 2020. And I think as a result of that, the market's kind of recognizing, hey, are we giving the stock a little bit too much momentum here for numbers that with high interest rates just are not going to be as good as we want them to be? Now, again, that's the bear case. The bull case is that FSD gets figured out within a year. The $25,000 car gets figured out within a year and a half. Cybertruck starts selling like gangbusters. There's a lot of catalysts for Tesla, even though there's a lot of bearishness today. But it's important to understand both perspectives to try to be able to come to a meaningful understanding of what's going on with Tesla. There's a real reason to be skeptical right now, which is why it's a good buy if you have long-term conviction as rate change. I agree. I mean, if you have long-term conviction on Tesla for the next 10 years, then there is a ton of reasons to buy on the dip. But if you're looking for a better price, then maybe you want to see it go lower. Okay, so we got about 2 minutes until the market open. Let's get that ready to go. If you are just joining, 10 years at 4.9%, which is one of the things that's hurting a lot of the market. I talked about early in the stream when I was 10 years old, I had no responsibilities. I enjoyed life. I was 10 years old. I was 10 years old in 2007 and the great financial crisis was about to happen. I remember watching the news with my friend. His name was Ronald. So this is not a fake story. I'm not making this up. And me and Ronald were in our house and or in my house. He came over. We were watching TV and then the news popped up. And I remember this 2007, the guy was like, people are losing their houses and all this stuff. And me and Ronald were talking. We were like, yo, what if our parents lose our house? And he's like, yeah, that'd be crazy. And then we're like, all right, so what do you want to eat? So we talked about it for like 5 seconds because we saw it on the news. And then we were like, all right, so what games do you want to play now? Because we didn't care because we were 10 years old. We didn't have a care in the world. Okay. Our parents had to deal with that stuff. Ronald's parents ended up losing their house. Actually, they had to move to the apartments. My parents, ended up keeping their house. So it was actually like there were people I knew that were affected by this. But now the 10-year, when I don't think of the sweet memories of when I was 10 years old. I think of just 4.9 to 5%. And I'm like, please to God, don't go to 5%, right? Like that's what I have to deal with now as I look at the 10-year. So times have changed. Times have absolutely changed. All right, we got a minute until this market opens. Here we go. S&P at 430 right now. Tesla at down 7%. Tesla will have all eyes on Tesla as the market opens. Palantir actually up in the pre-markets. 30 seconds, and let's see what direction the market decides to go today. And again, Netflix, shout out to Netflix shareholders. If you own the stock, you definitely deserve this. But 9 million subscribers is absolutely incredible. So you guys definitely deserve the pump, the 16% pump we're seeing today. 16% is a lot in one day for Netflix. All right, here we go. Ladies and gentlemen, thank you all for being here. It is time to open the markets once again. The stock market is now open. Wake your ass up. Here we go. Let's get into it. The market is open once again. Netflix opening up 16.3% on the day at $402. Tesla down 7.48% as we open up the day. Tesla is down. It is down from yesterday as well. It was down about 9%. So almost 16% in the past couple of days, $225 on Tesla. We'll get back to that in a second. 430 on the S&P 500, 430.96, up 0.17%. Palantir is 1740, up 1.16%. Palantir continuing to get the premium around defense, everything going on in Israel. Palantir getting more of a premium from the market at 1740, still down from 18, but not bad at 1740, staying in that range. SoFi 775. This one got hammered yesterday. It was at 873. I looked at 4 o'clock. It was down below $8. So the banks definitely got hurt yesterday, and SoFi being one of those banks that got hurt. Let's go to Truist. They had earnings today. I did a segment on them. I think their earnings were okay. They're up 2%. I think they deserve to be up 2%. They increased deposits by $1 billion. The cost of those deposits also increased, but in a world in which JP Morgan, Goldman Sachs, Bank of America have deposits leaving, for Truist to increase deposits was actually a really interesting sign, in my opinion. So Truist, not bad at all, $29.50. One of the regionals that ended up not having a horrible earnings, and now we'll just see, how their earnings end up going in the future. Again, Palantir is 1740. We got Delta, American Airlines, and United. All of these guys are up, barely up, but they deserve to be up a little bit after yesterday because they all declined dramatically. United was down about 9% on the day. So American Airlines cut their profit forecast, but they are still up about 2% on the day. NVIDIA, $425. Fubo, $2.51. NASDAQ, 13,368, opening up 53 points higher, up 0.40%. SMCI, 286. TSM, 94. AMD, 104. So the semis are getting a little bit of love. Obviously, NVIDIA fell from 460 to 425, so that's bad, but recovering a little bit and starting to see some green, pointing to signs that maybe these companies are a bit oversold on the China news that came out on Tuesday. You've got Apple at 176. Apple basically been flat in that range. Unity at 27. Unity down from 29, 1.53%. Lululemon at 406, now in the S&P 500. What else do we have? Rivian. Oh, wow. Yeah, Rivian's probably also going to be down on the Tesla news. Where's NIO? I imagine this Tesla news is not great for NIO. Yeah, NIO at $7. This one's tough. I have sympathy for those that love NIO. I really do. But NIO's a tough one. $7. And when I mean sympathy, I mean sympathy for my sister who bought NIO at $58. And I told her to sell it at 15. I was like, she was one of those in 2021 that got caught up in the hype. She's like, it's the next Tesla. I was like, all right, look, it's not the next Tesla. It's at $15. At least save your $15. She's like, nope, it'll go back to 58. I was like, all right. One day, maybe you'll break even on that. So trust me, I have a lot of sympathy for those that are stuck in NIO. Uber at $43. Bitcoin, $28,580. Some of the Bitcoin companies are running as well. CleanSpark up 0.5%. Marathon up 2%. Coinbase up 1% as well. Disney 84.63. That activist investor has come in, kind of stuck in that 84-ish range. It did hit 86.29 a couple days ago. Arc Innovation at 37. DNA $1.60, Microsoft 334. We're seeing big tech green and some of these SaaS companies green, and then all the spec plays like a Snapchat, which is not really spec, but it probably is spec even though it's been around for so long. Kind of down on the day. Enphase getting hit. Tesla now at 229. Tesla recovering a little bit. 226 was the bottom that we saw in the pre-market. Now at 229. Palantir 1737 down from 1740, but still green for the day. So Tesla 228 and Netflix falling below $400. So it was sold off as soon as it hit that 403 level. Now at 395, up 14% instead of 17% for the day on Netflix. Tesla 228. I did a poll in the chat. How many people would buy versus sell the dip? We got 316 votes. 62% of you said you would buy the dip on Tesla. 38% said no. So 62% think this is a great price. 38% said no. ADJ in the chat says, admit, brother, am I crazy to believe that SoFi is the best buy right now with a catalyst coming in the next 2 quarters? I think SoFi is a great buy. The problem is it is still a speculative company. I think there's a ton of catalysts. I think profitability is coming. Member growth is coming. Student loan originations. There's a lot of great stuff for SoFi. But if we get a credit event or any form of a recession or higher interest rates, remember, SoFi yet is still not profitable, and they're a growth company, and that growth is going to decline, and they don't have a dividend to keep investors excited. So I like SoFi under 8. I do, but I don't know if it's the best buy in the world if, we have a recession. That would be my bear case for SoFi. Blake says, I just bought 3 Tesla shares. I have a limit order of Tesla at 200 from George. 10-year might go to 6%. Yeah, if that happens, then 228 is definitely not cheap. Right now, 10-year at 4.943. It is up from when we talked about it in the pre-market. So it's at its highest it's ever been all day, 4.943. And it's interesting. We're going to see how equities react to the 10-year being at this level. Market not healthy with geopolitical situation. Yeah, I mean, we're seeing that happen as well. Look, the Fed is also speaking today. There's a lot of Fed speeches going on. So this is what's happening today. Let me just share the screen. So we have a lot of Fed. So this also is important because, I mean, if the Fed ends up saying a bunch of random stuff today, it's definitely going to affect, different parts of the market. Philip Jefferson is at 9 a.m. Jerome Powell's at 12 p.m. Austin Goolsbee, the name just sounds scary, 1:20 p.m. Michael Barr, 1:30, and then all these other guys are speaking all day. For some reason, we have 7 different Fed speeches today. And apparently October 19th, exactly 36 years ago today, the stock market had its worst day ever in history. Wow. The Dow Jones unexpectedly fell over 22% that day for no reason. This is the New York Times on 36 years ago, 1987, October 19th. 1987 was not a good year for the stock market, if I remember. 1987 was pretty tough. Oh no, this is 1992. This is a different time. So either way, I mean, it was a tough market back then, and let's see. Hopefully that doesn't happen today. But the Fed is speaking a lot, and whatever the Fed is going to say is definitely going to affect a bunch of different things that are going on. Let's take one more look at equities, and then we'll get into some more macro stuff going on. The war in Israel is continuing to persist. Biden is on a flight to the United States right now. He spoke with Prime Minister Benjamin Netanyahu. It seems like there is overwhelming evidence from not only U.S. intelligence, but Israeli intelligence that hospital bombing that now apparently wasn't a hospital bombing, it was a parking lot bombing, was indeed from a failed rocket launch in Gaza. So, I mean, it's not fully definitive, but from the evidence that most people have presented, and it's pretty basic, conclusive evidence. It's not really that complicated. It doesn't seem like propaganda. It seemed like that might have been a failed missile launch. Nonetheless, it has definitely left a lot of people annoyed at Israel if the perception is that Israel did it. And so it's just heightened tensions even more, and it's made things even a little bit tougher. So this war is going to happen. I think Israel is waiting for a full ground offensive, but if they go in, then we are officially going to be in a full-on war. And the question is just, when do they want to do that? Tesla right now at 226, so it's falling a little bit low from its 229 recovery. Right now it's 6.5%. It doesn't look like it's necessarily going to have a great day, especially with the 10-year being where it is right now. So Tesla, I mean, we'll see throughout 12 p.m., 1 p.m. where it ends up going. Palantir also down about 1% of the day. Now it's 1702, a little bit away from 1698. There you go. On Palantir, we'll see where it goes from there. David says, once the 10-year crosses 5%, it will spook the markets. And I think that's the question. I think that is the question. When the 10-year finally does that, if it does that, will the markets officially say, all right, we've had enough? I don't know. I guess we will have to end up seeing if that's the case. Let's get an update from one of the better analysts, Mohammed El-Erian, talking a little bit more about what the market's reacting to in regards to some of the geopolitical instability. For those asking for the NHS deal, hopefully coming out soon, but don't have an answer on that yet.
Sharply yesterday as Treasury yields surged to multi-year highs. Rates will be in focus again today as traders await a key speech from Jay Powell at noon. Joining us now is Mohammed El-Erian, Chief Economic Advisor at Allianz and President of Queen's College at Cambridge University. He's also co-author of a new book, Permacrisis, A Plan to Fix a Fractured World. Mohammed, good morning.
Good morning, Mike.
So, of course, we've been talking about the Treasury market. It's using up a lot of the market's oxygen here, clicking toward 5% on the 10-year Treasury. Now, there's a world in which you can say, oh, we're just pricing out imminent recession risk, and investors at the long end are now getting properly compensated, perhaps for the risk of holding longer-term fixed income securities. And there's a way you can find that there's an equilibrium that stocks can reach with this. On the other hand, we're not really repricing the Fed path very much. Inflation expectations are not seemingly behind the move, and the moves have been violent. So how do you read the why of what's happening with bond markets and the implications of it?
So as you say, you can provide very focused answers, but that's not the point. The point is twofold. One is that this market has lost its anchors. It's lost its policy anchor, it's lost its technical anchor, and it's lost its economic anchor. Policy-wise, if the Fed is excessively data dependent, it doesn't provide enough of a forward look as to where it's going. Add to that there's debate about R-star, there's debate about the lagged effects of the rate hikes, there's debate about the monetary framework, there's debate about, as well, what do you do with QT? So policy is not an anchor. Technicals are not an anchor because we have lost the reliable buyers. We've lost the Fed. We're losing China. The latest data show that China is reducing. Institutional investors are underwater. We've lost them. And we may also lose Japan. And then the economic anchors are on there. And then short term, and that's what's of concern, is the inherent stabilizers are weakening. So people who would come in every time yield went up in order to lock in that interest rates have been catching a falling knife. So they're
Yeah, and I think that's the biggest thing Mohammed's saying right here, right? For those that wanted that beautiful 10-year yield and they're coming in when it's being sold off to capture a higher yield, well, they're catching a falling knife on that yield every single time because it continues to end up going higher. And so right now, that's one of the biggest situations we're seeing in the stock market. I think what Mohammed's saying about the market having no anchors, I think there is some truth to that. Institutional investors are underwater. Retail investors are underwater. Obviously these money market funds scraping liquidity from the market. So it's tough to imagine what are the core anchors for the economy outside of the fact that maybe people get excited when they feel we're oversold and inflation comes down and then they want to participate in a rally. I want to share this first. So jobs claim, we have the jobs report. Let's talk about that. That's very important. So we got 198,000 jobs fewer than what we're expected. So we got 113,000 fewer. So we expected 210,000 jobs to come in, or jobless claims, sorry. And we got 198,000. That's actually not good for the market, I believe. So for example, for a jobless claim, you're expecting people to lose their jobs, which will increase unemployment. If we increase unemployment, we'll decrease inflation. If we decrease inflation, stocks can go up. If less people are reporting that they don't have a job, that means the consumer is actually still good. 13,000, I don't know. Is that a rounding error? Is that a lot of people? But they did this jobs report is hot. It's continuing to be hot. The last jobs report was also hot. We had like 100,000 more jobs we gained than expected. We had 9.4 million open jobs. We thought we would have 8.8 million open jobs. So right now, it seems like there are less people losing their jobs, which means if there's more people, with jobs, that means more money going into the economy. That means more people can buy Lululemon. The consumer is not in that type of situation. The labor market has been a critical factor in the Federal Reserve's deliberations over monetary policy. Officials worry that a still tight labor market could provide upward pressure on prices, even if after the central bank has raised rates 11 times since last year, totaling a 5.25% interest rate hike that we're getting right now. So that jobs report also not as bullish for the economy. Now, here's what the Fed could say today. The stakes are raised for Powell's speech Thursday with a 10-year yield on the cups of 5%. Here's some of the stuff that he could end up saying. Quote, Powell is always tackling back to whatever helps feed the narrative that they need to stay vigilant for all understandable reasons. I just expect him to keep talking about the strength of the economy and the surprising strength of the consumer. In the third quarter is a risk for inflation. That is enough ammunition to keep talking about staying vigilant. And look, that is absolutely correct. Powell only has to talk about the consumer continuing to have the strength that they're showcasing, and these Q3 earnings being a sign of that strength. And as a result of that, he can say, look, people aren't losing their jobs. People are started businesses. People are this. Bank deposits are fine, blah, 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 blah. That means inflation can come back. And if we don't get rid of inflation, there's no reason to be dovish. Markets largely expect the Fed to stay on hold with rates, but they will be looking to Powell for confirmation. Higher for longer on rates has become an unofficial mantra in recent days, and Powell's expected to join the chorus. And he's going to be talking Thursday afternoon in New York City. Yeah, I mean, I don't think they're raising rates again, but definitely you never know how the markets are going to be reacting to what Jerome Powell says. UAW strike still not beginning unemployment. No, remember, those people are on strike. They're not officially unemployed yet. They have led to different OEMs and suppliers laying off their employees, but the actual people on strike have not officially gone unemployed. OBG says if the Fed says they are done raising rates, the 10-year will stop rallying. They keep implying that they might raise rates. And again, see, this is the balance that we're dealing with in the markets. They keep implying that they're going to raise rates because their argument is that if we don't imply that we're going to raise rates, then inflation is going to spike again. But if you keep implying you're going to raise rates, that 10-year is going to keep spiking because people are going to sell off those bonds. Yield's going to get higher. And that in and of itself might be a detriment towards inflation coming down. So there's like this weird circus of how do we deal with this situation. That's why, for all the shit I give Jerome Powell, I give him a lot of credit because it's tough to walk that line. I definitely could not walk that line. That's a very tough situation. But nonetheless, something's going to happen. And either the 10-year is going to crack higher or, Jerome's going to be a little bit more dovish and we'll see it come down a little bit. And we'll see where it goes from there. Let's take another look at equities and see where we are. Inbounds at the stimmies was peak life, not going to lie. Bro, I gave my stimulus check to my dad. So it was, think about all the trauma we're going through in the economy for $1,200, bro. Like, you kind of look back on it, you're like, maybe $1,200 wasn't worth it. Maybe, maybe they could have given us like $300 and we would printing that much money, maybe. It's at least I think the Biden stimulus print in 2021, I don't know if we had to do that. Okay, now maybe I'm speaking from a privileged situation of someone who didn't necessarily need that extra $1,400 or whatever he was providing. But I don't know, bro. Maybe that one was a little bit over the brink. But that was tough. What do you think about ChargePoint stock? It has the largest EV network in the USA. I think ChargePoint has been a disappointment for a lot of shareholders, right? That's not been an exciting company. Let me look at it here. Look, if you're interested in EV charging, I would just buy Tesla. It was at 14. It was at 19 in 2022. This year, it was at $9. No, it was at the beginning of the year, it was at 11. Now it's at 3. I don't know much about their financials or details, but these are weird speculative companies people like buying. I mean, look, like if you're interested in EVs or charging, I would buy Tesla. I mean, I don't know what's the point of taking a risk on a company like this. I know it's a small cap, so maybe there's something I don't know about it, but yeah, just when people talk about companies like this, I just go back to like, if it's not beating the supercharging network, so I don't know why it's so exciting. Tesla at 224, we're seeing a new bottom on Tesla, down 7.64% on the day. 226 used to be the bottom. Now it's at 224. So we're seeing that dip get even dippier. Truist up 3% on the day, 29.65. Again, their earnings were not too bad. Enphase continuing to decline because of Tesla's going to go down. Enphase is going to go down. Netflix at 397. S&P 500 still being resilient, green for the day at 430. And Palantir at 17.18. It's a green market in some areas, a red market in other areas, but the story of the day is Tesla. That's it. Oh, now we're at 223. Yeah, look, see, this is what I'm saying in terms of buying the dip. You want to wait a little bit before you buy. Like, it's always nice to wait a little, kind of see what ends up happening. Especially, it doesn't take a rocket scientist to figure out the market sentiment around Tesla is just not good after that earnings call. I mean, Elon was not happy on that call. He went on a weird rant for people that work from home. And it was like, why are you ranting about people that work from home? He was just going off on stuff that didn't make any sense. It was weird, And it was just like, all right, Tesla. All right, I guess Elon's just annoyed at stuff. So now we're seeing Tesla down a little bit here. But what else do we got? All these companies are using Tesla as their primary charging source. Yeah, that's the other thing. If all those companies are using Tesla as the charging source, is ChargePoint really that exciting? Some of the big guys, it's just hard to go against some of the big guys. Like competing with EV, like Rocket Lab is interesting, but you also have SpaceX. Now, Rocket Lab has its own merits, but I think every investor needs to think, well, what about SpaceX? And yes, I know they're a little bit different in different areas. I get it, but still, it's a company that's going up against a big dog that's out there. And so there's just things to take into account when you're thinking of some of these smaller companies going up against more established players. NASDAQ at 13,325, S&P 500 at 430. So red market, folks. Even though we're green on some of the indices, it is still a red market that we're seeing right now. Okay, so we got another piece of news that we got to talk about. And that has to do with some of the social media. So apparently, Twitter is kind of thinking of stopping people to have access in Europe because of some of the regulations coming out in Europe. We saw what happened in Canada, right? Bloomberg, Wall Street Journal, all the news sources are banned in Canada on Facebook and Instagram because the Canadian government is trying to get Facebook to pay for accessing traffic. That's not really happening, right? Like Facebook's like, hey, we're not going to do that. Now Twitter is getting asked by the EU to comply with certain speech regulations. And obviously, if you know why Elon bought Twitter, that's not going to happen. Why does this affect Tesla? Because if Twitter goes off in the EU, they lose a lot of users, they lose a lot of revenue, and then Elon has to sell Tesla stock to pay down the $13 billion of debt he has on Twitter. There is no other way Elon can afford Twitter outside of selling Tesla stock. So I think if you're a Tesla shareholder, you really do have to be concerned about what's going on in Twitter, because there's going to be a lot of different ways that it ends up affecting. So here's the article that I want to share real quick. This is the headline. Meta, X, and TikTok are getting a EU request for info on response to Israel-Hamas war. So obviously a lot of people are posting on a lot of different subjects around what's going on with Israel, Palestine, Hamas on the main social platforms. And the EU wants to know what's their response. A TikTok spokesperson sent us the statement. We just heard from the EU this morning, and our team is currently reviewing the request for information. We'll publish our first transparency report, and we'll include more information about our ongoing work to keep the European community safe. Let me just say, Twitter is likely not doing that. I don't think Twitter gives a you-know-what about keeping the quote-unquote European community safe, which just means censorship. That's all it means, right? Like, we're all adults here. That's what it means. And so that's why the reports were coming out yesterday that if Elon doesn't comply with this, like, commission or this request for proposal around information on the response to the war, which, by the way, Twitter's response has been to let everything stay up. There is a ton of misinformation on Twitter. There's a ton of real stuff. There's a ton of gory violence. Like, Twitter's like, it's anything could be on the platform. And if Elon didn't own it, that would not be the case. If that happens, maybe it's a long shot, but it was being rumored yesterday that maybe the EU cuts off Twitter. We saw Canada cut off, news sources in the context of Instagram and Facebook. And if that's the case, that's not good for shareholders of Tesla or for users of Twitter, in my opinion. So we're going to end up seeing what happens. But that is one news story that I wanted to bring as well. Austin says, do you see any of the other top 7 stocks being affected from high rates, thinking Apple and NVIDIA? Yeah, I think NVIDIA, the biggest one. I think Google is the one that's least susceptible to some of those rates, but Apple is the biggest one for me, especially with iPhone sales being down in China. It's less about rates, in my opinion. It's more so about, like, people just don't want to buy all their stuff, and services is not growing as fast as they need it to be. So the Vision Pro is still not proven. I mean, again, 3,500 is a bit insane, but we'll see if they end up proving that. All right, word of the day. Let's get that one done. Remember, mollycoddle was one of the words this of the week that we did, I think, on Tuesday, and I love that word. So that was a good one. Yesterday was some scary word that I forgot already, but it had the word GBs in it. Today, the word of the day. This website is just really interesting. Shower orange.
Shower orange or shower orange.
I'm so mad she did 2 different versions of it. Okay, so shower orange is an orange that is peeled and eaten under a steamy shower. You've got to be kidding me. The purported benefit being that the steam enhances the orange's citrusy fragrance and creates a soothing experience for the person who is showering. Okay, so I know you guys have never heard of this before, ever. There's no way you never heard of this before. Oh, look, there's a video on this. Shower orange. Okay, so it was first recorded in 2015 to 2020, so this is recent. Examples: I indulged in a refreshing shower orange this morning, savoring the citrusy aroma and the relaxing sensation. Enjoying a steamy shower orange is not only a delicious way to satisfy your cravings, but also a self-care ritual that offers an invigorating and calming experience. Dude, there's no way that this is a word. There's no way that this is a word. This is insane. I cannot believe that if this is a word that apparently was added to the dictionary in 2015. I kind of might do this, bro. I don't eat oranges. I'm more of a banana type of guy. I like things that are long and, go into my mouth. But shower orange is a little ridiculous. All right, let's do another one. Quintessence, Merriam-Webster. Let's do this one.
Quintessence.
Quintessence is a formal word that can refer to the most typical or perfect example of something or the most important part of something. Roasting marshmallows over an open fire and making s'mores is the quintessence of camping in the great outdoors. Okay. That's a better one. That's a better one. Quintessence. Today, everyone enjoy a shower orange. Yeah, we are getting some interesting words of the days. Who's wasting their oranges in the tub? But we are getting some orange. All right, so let me know if you take a shower orange anytime soon. I'll let you know if I do it. I'm actually kind of curious of doing it right now. The citrusy aroma in the steaming shower. Let's see if that makes me feel better or anything. Okay, that's it for me. Thank you guys for listening. Thank you guys for watching. We'll have another episode of Pouncer Daily out today. We'll be on Finance Junkies. Maybe the guys are getting a little busy, so we'll see if we're able to do it today. If not, then yeah, I will see you guys tomorrow morning, and we'll see how the market reacts. Last one, quick look at the market. S&P 500 at 430, Truist at 29.42, Netflix 3.99, Tesla 2.24, Palantir at 17.25, and the 10-year 4.932. So actually ticking down a little bit from when we talked about it. All right, that's it for me. Thank you everybody for joining. I will see you in the morning. Have a great Thursday. Bye everyone.